Speculation and debt have something in common. They both feel manageable right before they become dangerous. Whether we're talking about investment bubbles or credit cards, the warning signs usually appear long before the consequences do. I'm Christiana Lovelace. I'm a licensed financial advisor, an accredited asset management specialist, and the owner of Diamond Point Financial. Each week on Pointe Perspective, we step inside the analytical process behind financial decision making, breaking down how professional investors interpret the system and build strategies designed to move with it. Over the last several weeks, we've been discussing debt, positioning, and how different parts of the financial system respond to changing environments. This week, we're focusing on momentum, expectations, and consistency. First, we'll break down the growing conversation surrounding an AI bubble and how today's environment compares to the dot-com era. Second, we'll walk through how Federal Reserve meetings operate and how policy decisions are communicated to the public. And third, we'll continue our focus on debt by discussing different approaches to paying it off and why consistency often matters more than chasing the perfect strategy. Whether we're talking about markets, monetary policy, or your own financial plan, fundamentals and stability matter more than short-term momentum. Over the last several years, artificial intelligence has become one of the most dominant themes in the market. With the speed of that growth, a lot of investors have started asking the same question. Are we in a bubble? More specifically, is this similar to what we saw during the dot-com bubble in the late 90s and early 2000s? While there are definitely similarities worth discussing, there are also some very important differences. During the dot-com bubble, many technology companies were trading at extremely high valuations, despite having little or no earnings, little cash flow, and in some cases, no proven business model at all. At the time, investors were pouring money into internet-related companies based almost entirely on future expectations. Some companies even saw their stock prices surge simply by adding .com to their name. Capital was cheap, speculation was extreme, and profitability often became secondary to growth potential and excitement. Over time, those expectations became disconnected from reality, and a large portion of those companies collapsed. Now, fast forward to today's AI rally. There are absolutely some speculative areas within artificial intelligence, particularly among smaller companies trying to capitalize on the excitement. But a lot of today's market leadership is concentrated in companies that are already highly profitable, already generating enormous cash flow, and deeply integrated into the global economy. Many of the companies driving AI development today are not startup shell companies with no revenue. They are some of the largest and most financially powerful companies in the world. Now, that doesn't mean parts of this market can't become overvalued. Speculation can absolutely exist inside a legitimate shift. The internet changed the world, but not every internet company survived, and AI may ultimately have a similar outcome. The broader technology itself may continue transforming industries, while certain companies within that space still struggle due to valuation pressure, competition, leverage, or just unrealistic expectations. We're also seeing another topic become more common in this conversation recently, and that's the discussion around circular funding. At a very basic level, circular funding refers to situations where companies raise capital or invest in each other's ecosystem, or just rely on interconnected financing structures that can sometimes inflate valuations and momentum through a sector. While that doesn't automatically mean something is fraudulent or unstable, it can increase systemic risk if growth expectations begin to slow or capital becomes more restrictive, especially in environments where investors are aggressively chasing the same theme at the same time. This also ties back to what we discussed previously regarding leverage and debt within the market. Some companies are funding AI expansion from positions of significant strength, using existing cash flow and strong balance sheets. Others are relying more heavily on debt, outside funding, or aggressive growth assumptions in order to keep pace with the industry. And over time, markets tend to separate these two groups. As Warren Buffett would say, at some point the tide will go out, and when it does, we'll see who's swimming naked. Because when liquidity tightens or expectations shift, stronger balance sheets will matter a lot more. This is one of the reasons diversification and asset allocation remains so important. Even during periods where one theme like AI might dominate headlines, Strategic portfolios are still built around balance and structure. We're not simply chasing whichever area has the most excitement. When areas of opportunity emerge, the goal is to maintain responsible exposure within the context of the broader portfolio. We can recognize that AI might continue playing a significant role in the future economy, while also understanding that not every company connected to it will benefit equally over time. So when investors ask whether we're in an AI bubble, my professional opinion is there may absolutely be pockets of speculation within the space, but structurally, today's environment is very different from the dot-com era. Excitement alone doesn't determine whether something is sustainable. Cash flow, earnings, balance sheet strength, and realistic expectations still matter. When the flash fades, those fundamentals tend to stand out very quickly. Last week, we talked about how the Federal Reserve is structured and how monetary policy decisions are ultimately made through the Federal Open Market Committee, or the FOMC. This week, I'll explain how those meetings operate because they can carry significant influence and tend to shape expectations throughout the entire economy. The Federal Open Market Committee typically meets 8 scheduled times per year. During these meetings, the Federal Reserve evaluates economic conditions and decides whether changes to monetary policy may be appropriate. That includes decisions surrounding interest rates, liquidity conditions, and broader economic guidance. The meetings themselves include the 7 members of the Board of Governors, the president of the New York Federal Reserve Bank, and a rotating group of regional presidents who serve voting terms throughout the year. In addition to voting members, economists, analysts, and Federal Reserve staff also contribute research, economic projections, and policy analysis through the process. The committee reviews a wide range of economic data. That can include inflation, employment, consumer spending, wage growth, banking conditions, credit markets, GDP growth, and global economic development. The goal is to evaluate whether the current policy stance is helping maintain economic stability or whether adjustments may be needed. At the conclusion of the meeting, the committee votes on monetary policy decisions. They may choose to raise rates, lower rates, or to just maintain current policy levels. But what's important to understand is that markets don't just react to the decision itself. They also react to the language surrounding the decision. After the meeting concludes, the Federal Reserve releases an official policy statement to the public. That statement is analyzed almost immediately by investors, economists, banks, institutions, and the financial media. The chair of the Federal Reserve also holds a press conference. During this briefing, additional commentary is provided regarding inflation, economic risks, labor markets, future policy expectations, and the broader outlook for the economy. And sometimes the markets react more to one sentence in that press conference than the actual decision itself. This is one of the reasons financial markets can become so volatile around the FOMC meeting. As we've discussed, markets are forward-looking. They're not just reacting to what the Federal Reserve is doing today, they're reacting to what investors believe the Federal Reserve may do next. Expectations around future interest rates can influence everything from stock valuations and bond prices to mortgage rates, business borrowing, and consumer confidence. Which is why even relatively small changes in wording during these meetings can sometimes create major reactions throughout the markets. For the month of May, we've been focusing on debt, how it functions, how it affects your financial position, and how to begin managing it more intentionally. Last week, we talked about net worth and why understanding your balance sheet is such an important part of evaluating your financial progress. This week, we're focused on action because once you clearly understand your financial position, the next question becomes, where do I start? When it comes to debt payoff strategies, 2 of the most common practices are the snowball method and the avalanche method. Both are designed to help reduce debt over time, but they approach the process differently. Choosing the right strategy matters because personal behavior often plays a significant role in maintaining consistency. What works well for one person may not be the best fit for another. The snowball method focuses on paying off your smallest balances first, regardless of the interest rate. With this approach, you continue making minimum payments on all debts, but direct extra money toward the balances with the smallest amount until it's paid off. Then you roll that payment into the next smallest debt and continue building momentum over time. The benefit of this method is psychological. It creates smaller wins earlier in the process, which can help people stay motivated. The avalanche method works differently. Instead of focusing on the smallest balance first, it prioritizes the debt with the highest interest rate. Mathematically, this approach will often reduce total interest costs more efficiently over time. Higher interest debt tends to grow more aggressively. Paying it down first can potentially save money in the long run. But psychologically, this method can sometimes feel slower, especially if the higher interest debt also has the larger balance. This is where I think personal finance becomes more individualized than people sometimes realize. Because even the most mathematically efficient strategy doesn't matter very much if you can't realistically stick to it. For some people, seeing smaller debts disappear quickly creates the momentum that they need in order to stay disciplined. For others, focusing on reducing interest costs first may feel more logical and sustainable, but neither approach is right or wrong. The best strategy is often the one you can consistently follow within the context of your own financial life. I also think it's important to understand that paying off debt doesn't happen in isolation from the rest of your plan. You still need emergency savings, retirement contributions, stable cash flow, tax planning, and overall financial flexibility. Aggressively paying down debt while neglecting everything else can sometimes create financial pressure in another area. The goal is not simply to eliminate debt as fast as possible at all costs. The goal is to create a financial structure that becomes stronger, more stable, and more manageable over time. So as you begin evaluating your own debt payoff strategy, I want you to think beyond just the balances themselves. Think about your behavior, your cash flow, whether the plan is sustainable, and which approach gives you the highest probability of long-term success. Because strong financial planning cannot be built through extremes. It is built through discipline and consistency. Today we discussed how momentum and expectations can shape both markets and personal decisions. We looked at the growing conversation surrounding an AI bubble, we broke down how Federal Reserve meetings are structured, and we continued our discussion around debt and why consistency is often more important than trying to follow the perfect plan. If this helped bring some clarity to what you're seeing in the markets, in the economy, or in your own financial life, please subscribe to the channel for new discussions every Thursday. If you'd like a more concise breakdown, you can subscribe to our weekly newsletter, which is sent out every Friday. Or maybe you'd like to explore how this applies to your own financial situation. You can learn more about Diamond Point Financial using the information below. I hope this offered some useful perspective. Until next week, take care.